Welcome to The Explainer. We're jumping right in today because we need to talk about a number so large it almost defies modern economics. Some are saying that as of February 2026, we may have finally crossed a mathematical event horizon.
So let's get right to it. $2 trillion. As of right now, this month, this is the new annualized interest payment on the United States national debt. Now let's be crystal clear about what that means. This isn't paying down the debt itself. This isn't building roads or funding research. This is just the interest. It's purely the rent the United States now pays on past spending.
And this leads us to the central question, really the only question that matters right now. Is this just another painful recession that we can eventually work our way out of? Or is this something different? Have we hit a structural breaking point where the math itself guarantees the system can no longer save itself? That's what we're digging into today.
Okay, so to really wrap our heads around why that $2 trillion figure is so terrifying, we have to understand a key idea. It's a concept called dead capital. You know, when money is spent productively, it has velocity. It moves through the economy, it builds things, it pays salaries, it creates more value down the line. Dead capital, well, it's the exact opposite. It's spending that produces none of that. It's money that gets spent but creates zero return. It's like pouring water into sand. It just vanishes.
And this really shows you the difference in black and white. On one side, you have live capital. A great example is a hydroelectric dam. You spend money, but you create jobs. You get infrastructure. You get cheap energy. There's a tangible return on that investment. But then look at the other side, an interest payment. It's pure dead capital. It creates nothing. It's literally just a bill for things we already consumed maybe decades ago. And that's the gut punch of where we are now. That $2 trillion interest payment, it's not just another line item on a budget. It is without a doubt the single largest and purest example of dead capital in all of recorded history. It's a financial black hole, and it's actively sucking the future productivity of the entire country right into it. And just look at this chart to see what that really means. The cost to service our past debt now costs more than the entire national defense budget and all of Social Security combined. Think about that for a second. The money we're spending just to pay interest is more than what we spend to defend the country and support our seniors. We're literally sacrificing the present and the future just to pay for the past.
So, what's the actual trigger here? What makes this a potential point of no return? Well, this isn't based on feelings or forecasts. It comes down to a cold, hard mathematical formula that defines a truly terrifying condition.
And here it is. This is the equation for what some are calling systemic liquefaction. It's the moment when the growth of your interest payments officially becomes greater than the growth of your entire economy plus all the new money you collect in taxes. Once this inequality flips, you've hit the wall. You are mathematically incapable of growing your way out of the problem.
Let's walk through this. In a normal, healthy system, you grow your way out of debt. The economy expands, tax revenues go up, and you pay down what you owe. But in this liquefaction state, the debt itself becomes this monster that eats everything. Every new dollar of growth, every new dollar of tax revenue just gets fed straight to the interest payments. The system can't heal itself. Its very foundation turns from solid to liquid.
But hold on, I know what you might be thinking. Haven't we seen this movie before? People always bring up 1982. The Fed pivoted, saved the day, and kicked off a 40-year bull market. So, why can't we just do that again?
The short answer? Because today is nothing like 1982. Back then, U.S. debt to GDP was low, around 35%. The economy had massive runway to take on more leverage and grow. Today, we're saturated at over 120%. But even more importantly, the inflation is different. Back then, it was cyclical. Today, it's structural, baked into the system by things like deglobalization. The entire game has changed.
And this brings us to the checkmate, a situation where every possible move on the chessboard is a losing one. Let's look at the Fed's first option.
What if the Fed does the textbook move and raises interest rates to fight inflation? Well, that $2 trillion interest bill doesn't just go up, it explodes. It becomes $3 trillion, maybe $4 trillion, almost overnight. You would bankrupt the U.S. Treasury. So that move is completely off the board. The math forbids it.
Okay, so if you can't raise rates, what about cutting them? Let's try scenario B. Do the famous 1982 pivot and slash rates to give the government some breathing room from those crushing payments.
And here is the brutal irony. In 2026, that exact move would trigger a total currency collapse. It would signal to the entire world that the central bank has officially surrendered to inflation. So the very pivot that saved the system in 1982 is the precise mechanism that will destroy it today. The escape hatch has become the trapdoor. This is the refinancing cliff. This is checkmate.
So when you're faced with an inescapable trap like this, what does the so-called smart money do? Well, they're not waiting for the floor to give out. They're not panicking, but they are moving quietly. It's being called a silent migration.
And you can see it happening right here. Look at what other countries are doing with their reserves. Global central banks in nations like China, Russia, and Poland, they are rapidly moving away from financial promises, like U.S. bonds, and into physical weights, like gold and strategic commodities. They are trading paper for real stuff.
At its core, this is a fundamental flight from something called counterparty risk. Think about it. Almost every asset we own, a bank deposit, a stock, a bond, is really just a promise from someone else to pay you. But in a currency crisis, those promises either get broken or they get paid back with worthless money. Physical assets, like gold or energy, don't have that risk. Their value doesn't depend on someone else's promise.
And this whole migration points to a really profound psychological shift. It's a change in the fundamental goal of investing itself.
See, for the past 40 years, the game has been about return on capital. The main question was always, how much profit can I make? But in a world facing liquefaction, the goal changes completely. It becomes about return of capital. The question is no longer, how much can I make? It's, can I even get my original investment back with its purchasing power intact?
This is leading to a pretty stark consensus for those navigating this new reality. In a world where digital promises can be broken or simply debased into worthlessness, the focus is shifting to the tangible. The mantra is becoming, if you can't physically touch it, you don't truly own it.
So we've laid out the problem, the dead capital, the liquefaction formula, and the checkmate facing the Fed. This naturally leads us to the most important question of all. As the old system fails, how does an individual achieve what some are calling strategic sovereignty? That is a huge concept, and it's exactly what we will be exploring in our next explainer.